Real estate investing can bring big reward and big risks. So know your risks. Welcome to the Real Estate Risk Report, the show for real-world insight on real estate investment risk. Now, here's your host, Lance Peterson.
Thank you for joining the Real Estate Risk Report. I'm your host, as always, Lance Peterson. Thank you so much for joining us. So today, I have a couple of guys that are joining me from Meridian, Idaho. In fact, they are within a stone's throw from one another, and they happen to be business partners at Suncrest Capital. We have Ryan Hill and Brett Bowman. How you guys doing?
Doing great. Thanks for having us, Lance.
Great. Yeah. Thanks, Lance.
Yeah, super excited to have you guys. So Suncrest is a newer member to the Verivest Sponsor Network. As many of you know, that is my day job over at Verivest, and I moonlight doing this podcast. So super excited to discuss their strategy and their company today. These guys are mobile home park or manufactured home communities, whatever you want to call them. That's the business that they're in. They're acquiring and sort of repositioning those assets. And I'll have them sort of get into it a little bit more. But as we always do, I like to sort of give some context, let you see kind of the guests, their own journeys in real estate. Many of you that are listening to this are sort of in the not coming from real estate, more from the passive side. You're looking to invest as a limited partner or an investor and get into these deals. And we're here to help, do what I call take you from maybe being ignorant to becoming enlightened so that you can participate in, this real estate investment space as well. So Ryan, why don't you share with us how you ended up sort of getting into real estate and what led you to kind of, mobile home parks and manufactured homes?
Sure. Yeah. It started, I was a residential real estate agent in Washington State for about 13 years before my family and I moved over to Idaho a little over 2 years ago. At that point, I didn't feel like rebuilding clientele and rebuilding a business on the single family side of being a realtor. I've been self-educating myself on the mobile home space for probably 4-ish years or so. Finally got my wife on board with it, and we bought our first park a little over 2 years ago. So just a small one, just south of Kansas City, about 20 spaces total. About a year later, I met Brett and another partner, and we bought a second smaller park in the same town that I bought my first one. So it was off market. And so it's kind of crazy to think that a year ago only owned one park, and now we're up to 10, Brett?
Yeah.
Yeah.
Yep.
And with 2 more closing here pretty soon, and a few others under contract. So we're building fast, scaling fast, and loving the ride.
Yeah, that's great. Very good. Yeah. How about you, Brett? What, I know you've got a very interesting story that, I'm sure many of the people that are listening probably relate to as well. So how did you sort of end up here? But what, where did you kind of start?
Yeah. So my background's in tech. So I currently work at Apple, and I've been at Apple almost 7 years, actually. But on the side, I've been investing mostly in the past several years in like single family homes, and I was getting ready to scale up to fourplex, kind of do the typical BRRRR strategy that I think a lot of people do in that space. And I just kept getting frustrated with how expensive those were and how little cash flow there was and how hard it was to get, you got to do loans on every single one. And it's just a lot of work just to get it all set up. And then I started stumbling upon more commercial stuff and realized you can actually get into commercial much more easily than I thought. At the time, again, I was thinking in 100 years, I'd have enough fourplexes to be able to sell off and buy an apartment complex kind of thing. Yeah. And I realized actually you can come in and just own fractional portions of it and diversify your risk, get great cash flow, all that kind of stuff. So I got into multifamily and industrial syndications initially. And then Ryan and I started partnering, and I learned that mobile home parks are a pretty fantastic way to not only get great cash flow, but also have tons of forced appreciation through some sweat equity, which I'm sure we'll talk about more. Mm-hmm. So that's where I kind of found my passion with mobile home parks, and that's where Ryan and I are today.
Yeah, no, that's great. Yeah, like it is. It's one of those things. It's interesting. It's sort of it's a human thing, right? Is that being an entrepreneur, basically my entire adult life, it's like we grow up and we're taught to sort of be reasonable, right? I mean, when we're really young, we're not reasonable at all, right? Like we literally think we can do whatever. But, then you sort of, you get to the point where, it's sort of like you've been around long enough to be like, okay, you just have to be sort of reasonable and pragmatic. Like that's sort of what's expected of us. And, and you go about your business and that's what you do. And when I work with a lot of clients, deal guys like you guys, I have to kind of say like, hey, of course you need to be pragmatic. I mean, underwriting and detail oriented and all those sorts of things. But really a lot of times it is like, you do have to have some vision, right? Like it's one of those weird things where you don't need to go, single family to duplexes to fourplexes to, 16 units to whatever. I mean, you can, there's nothing wrong with that. Right. But sometimes it's like you need to go out and explore a bit and see maybe there are some other possibilities. I just had a call this morning with a guy saying, listen, I think it's going to be harder for you to raise $15 million than it would be to raise 100 million. He's like, what do you mean? I'm like, okay, you're basically, your story saying you want to revolutionize, military housing or whatever you're doing. But the scale you're talking about is gigantic, right? So you go and tell them it's 10 million, $15 million, then it just seems like you're aiming too low. Right. And I think that for some people, it's just realizing, or investors as well, it's like, well, I'm barely accredited, or I'm not even accredited yet, so I can't participate. That's not true, right? Like you have to do more investigation. There's ways to get access into these things if you're just a little, creative and resourceful, and you build some relationships with people. So I love hearing that, it's like, hey, you're doing one thing, you do some, more investigation, realize like, okay, if I understand how to buy a mobile home park, it's not all that different from buying a single family home, right? And there's other ways I can participate in the meantime. So with that said, for you guys, the mobile home park stuff has become, a bit of it's the darling strategy, at the moment, which I think is great. And we are seeing, a lot of the transition of, or, changing of hands from sort of long time mom and pop owners into, more sort of professional managers like yourselves, who are looking at kind of growing and scaling. And I think even the institutional investors are really interested in acquiring these stabilized assets. So for you guys, with that being said, how did you, Ryan, sort of narrow in on like, south of Kansas City, or, like, how did you go through that process of figuring out like okay, great, mobile home parks are awesome, but where should we start? Like, where should we be looking?
Yeah, I mean, I had no connections in the industry at the time. So I was probably like a lot of newbies in it, looking at LoopNet, Crexy, regional websites, just trying to find deals that looked okay, right? Had some good mentors along the way. And I found a deal that had been on LoopNet for a long time, I think 3 years or something, and it couldn't be bank financed. The owner he collected cash, didn't, not trusting of the banks, no financials. So there's no way a bank's going to finance that. So we got creative with some owner financing on that one. And so it worked out with the budget we had. I think we had about 80K to kind of put down on a property, and it worked well for this particular deal. And in fact, we're just the end of refinancing that now. We have enough background history on it. So looking for the major metro areas, like a lot of people. So we're just at the kind of the south edge of the KC metro.
Mm-hmm.
So 100,000 plus population is ideal, 40,000 K plus in median income, and 100,000 in median home price is kind of what we look for, at least in that metro area. So a lot of our properties are actually in maybe smaller towns, but within a larger metro area where there's people that commute. So that's where I ended up, and just found some good managers that are now our regional managers for all of our properties in Kansas and Iowa and Missouri. And they're excited to grow with us too. So that's how we landed there anyway. It was just a lot of hunting and picking. I probably looked at 150 to 200 properties before we finally landed on one.
And then you guys have said the velocity in your pipeline is really sort of, much more robust now. which is great. So what has sort of led to that? Is it really still a numbers game for you guys, where it's just picking up stones and turning them over, and you kind of got your, like you said, that criteria you listed out, and is that sort of how it's working, or what have you seen anything change from that early acquisitions to more recent ones?
Yeah, I'll start and then let you jump in there, Brett.
Sure. Yeah.
I think the deal flow, once you establish some credibility and reputation, and you've shown you can close a deal, then the deal quality coming to you is much better. So you start to get people to bring you off market pieces. Brokers start to listen to you a little bit more or want to work with you. So I'll let Brett kind of expand on how we're sourcing those right now.
Yeah, I think, I mean, definitely still the numbers game, but to Ryan's point, I think we're getting a ton more in our top level funnel of just like, we're getting lots of leads from just either wholesalers or people cold calling for us or brokers, all of that. And then kind of the second level of our filter is just like Ryan said, we have a pretty quick pass of like, is it in our geographic area that we need? Is it the size we need? Is it, you know, those kinds of things. And we'll stretch a little bit on our criteria if it's close to a park we already have. But like all the time I see exciting stuff in Kentucky or Texas or something. And at this point, we've just really decided we have to stay centralized to be able to scale and stay smart. So those ones are really easy for us to cross off the list. And then kind of the next level is quick underwriting, and then we do deep underwriting. So that funnel is just getting bigger and bigger with the numbers game, like you said. I think the other thing though is as we've both gotten better at the operations piece, I think deals we're looking at now that we're strongly considering we probably would have passed on a year ago, either because we didn't have the investor network to be able to raise the capital to buy it, or we didn't have the network of, you know, we'll probably get into the mechanics of how to operate mobile home parks, but a big piece is finding and infilling homes. And we've had a ton of success finding and bringing in homes into our parks already. So we're looking at parks now that have heavy infill needs. And again, a year ago, we probably would have shied away from that, but now we've got that network in place. We're actually establishing our own moving and toting business that will be able to do all of it for us. So just things like that are making it easier for us to take the numbers game and make them work more than they would have otherwise.
Yeah. So maybe hit on that a bit. So if I'm understanding you right, is that some of these parks, you look at the number of pads they have, they're in your geographic footprint, you know, scale, because the mobile home park business is more operational, I think, than many people realize, at least at first glance. So, I mean, that makes a ton of sense. So what you're kind of referring to is that you might run into a park where there's not a home on the pad.
Right. Absolutely.
Yeah. So it's like, great, you got some dirt there, but getting a home, that's the whole name of the game. There's got to be something sitting on top of it that's going to pay some lot rent. And that's, you know, easier said than done. So it sounds like before you just like even sourcing homes to bring in to then potentially sell to people or, you know, lease to own, or maybe give a little more color on what.
Yeah. For sure. So I think, and we were talking before we started recording, Lance, one of the things that I think is a misconception in the business is that it's really easy to operate a mobile home park. And that's true if the mobile home park is stabilized. So for example, if you have 100 pads and 95% of them are occupied, that's probably going to be a pretty easy park to manage, especially if all 95 of those are owned by the tenants themselves versus you. What we're generally looking at is those parks that have 100 pads, for example, maybe only 60 of them are occupied. So there's 40 that are vacant. And we do like to see that a healthy mix of those 60 that are there owned by the residents themselves versus being owned by the park. But we're not afraid of taking on homes that are owned by the park. But we will convert them over to tenant owned as quickly as possible. So there's a bunch of elements that go into, like, if you've got 40 homes to fill in there, you've got to make sure that you've got infrastructure to all those pads, because sometimes they'll say there's 40 vacant lots, but really it's only 35 because either it's a size problem or you can't get infrastructure to it or whatever it is. And then the next big thing is finding a home and bringing it in. And depending on the market, we do a lot of analysis up front. We do test ads to make sure we've got the right demand and economic kind of criteria that we're looking for. Depending on all of that, we'll either bring in quality used homes that we source, or we'll bring in brand new homes, depending on what we can sell and what the demand looks like. But bringing in, I mean, either one of those have been challenging with COVID because of the demand being just so high, everybody's buying those up. So we've had to be creative about how to source them. Then you got to move it, and the moving piece is 3,000 to 5,000 minimum just to move it. And we've had quotes that literally moving a home from one side of the same community to the next side is $3,000, and it's like literally less than a mile drive, right? So it can be expensive, and so that's why we said earlier we've invested in our own toting business so that we can move the homes ourselves to help with that. Then once it's installed, you've got to actually sell the home to somebody, and they have to get qualified for generally you want to get them qualified for their own mortgage. And there's a bunch of different lenders in the business, including Warren Buffett. Berkshire Hathaway owns 21st Century Mortgage, which is probably the largest lender to mobile homes. So ideal situation is the resident comes in and they get qualified for one of these mortgage programs. So then it's off your books altogether and you get the capital back. Fantastic. End of the story. You're getting your lot rent, which is what everybody wants. We don't really care about the home rent so much. But then there's also sort of this backup plan of, like you said, lease to own programs that you can do where you still carry the value of the home and you own the home. We're responsible for the taxes and insurance on it, but the resident is then responsible for like any maintenance expenses, all of that work, because theoretically they own it. It's just that they don't have those other two underlying expenses. So with that situation, that can be nice because you're getting extra cash flow, but it's still not our ideal situation because from a valuation perspective, when you go to sell or refinance the park, banks sort of ignore that income anyway. So it's like it's nice cash flow, but it doesn't actually increase the value of your park. So you have extra overhead of managing that without actually benefiting from the valuation. Does that make sense?
Yeah, no, it does. And I think that's, I think the important thing to realize that's changed. And once again, just to kind of pan out that, these assets were mom and pop owned for years and years and years and years and ignored for, more years than they've been sort of the darling. Right. And when when you think about it, it's sort of what you're speaking to, right, Brett, it's that it now that there's sort of a market that's willing to acquire them when they're stable, meaning they view these as sort of potentially institutional quality assets that they're willing. I mean, even single family, it's I know it's weird, but it was really the global financial crisis that led to institutional investors getting into single family. And it's of course now I think most people think, well, of course, didn't they always? It's like, no, they didn't, right? But now when you look at the percentage of single family rentals that are owned by institutional investors, that percentage today is 50 times what it was before that happened. And I think that's really one of the things, I think the big ahas, right? And we talk with groups like Suncrest, Ryan and Brett, is that they first and foremost have to be good at the operational side, right? Like the things you just talked about. Let's go buy, let's invest into a company that moves the assets. How do we source them? Because if you don't have those connections, you're stuck. Like, and you go in like, oh, I got this great deal. But if you can't get homes on there, get people to buy them, it's all operational. And if you're not good at that, that asset won't go up in value. It could go down in value, right? And if everyone moves, and once again, if they all decide to take the homes that they did own that were on your lot and move them out of there, it's hard to get them back into the park. Right. And so those are things that are important. But the beauty of this now is that the fact that there are investors, when these guys figure out how to get 95 of the 100 pads have, tenant owned homes on there paying lot rent, and it's stable, that's where you get the valuation, right? Like that's sort of
exactly. Yep. That's exactly it.
Yeah. And on that, the forced appreciation piece, for each home that we infill, it's depending on lot rent. It can add anywhere from 50 to 60,000 in the value of that particular property. And a lot of the homes that we are acquiring, like the all-in cost for purchase, moving, rehab, might be in the $20,000 to $25,000 range. So it's just a crazy upside for each home you move in. Now, it takes a lot of work and there's a lot of moving pieces, which is why we're buying our own toter, because we've had homes scheduled out 2 to 3 months, and they keep getting pushed out more and more because of weather, or the company has breakdowns, or whatever it might be. So we want to take more control over that process ourselves. So it's a little more efficient on that side.
Yeah, no, it makes a lot of sense. And then from a passive investor standpoint, right? It's like understanding what the strategy is, understanding sort of like how to figure out, whether someone's capable of executing the business plan. A lot of the things you guys talked about, but some of these benefits, maybe get into that, because you touched on it, Brett. With the depreciation benefits. So you've got these assets that you start stabilize, lots of cash flow, right? So there's a lot of really strong cash flow, but that depreciation benefit, maybe speak to what that is and how it kind of pertains and works as for a mobile home park. I mean, a lot of guys might understand like the multifamily stuff, but maybe not the mobile homes.
Yeah, so this is really fascinating to me when I first learned about this, and I spoke with a couple of not only CPAs, but also people in the cost segregation business. And I always would have assumed that your depreciation benefit for a mobile home park is much less than it would be in other asset classes, because you don't have as much of a structure there. But it's actually the opposite. So the first big thing is that the depreciation schedule for a mobile home park is shorter. So it's generally 15 years instead of the typical 27 and a half. So then when you do the cost segregation study, which I don't know, should we kind of explain what that is, some background on that?
I'd say hit on that for those who are familiar. Yeah.
Sure. So a cost segregation study is essentially when you have a certified engineer, and often they're engineer and CPA, or at least they have them within the same firm. They go out and assess all of the assets on a property. So they're looking down to like literally tile versus linoleum. Those are depreciated differently. They're looking at carpet, any sheetrock, whatever, like very, very detailed, that they're going through and doing all this. And so with the mobile home park specifically, they're looking at anything above ground. So any of our infrastructure we put in, any concrete, any homes that we still own that aren't owned by the residents themselves, all those kinds of things are taken into account. And then they essentially put everything on a schedule. So depending on what it is, it might be on a 15-year schedule to be depreciated, or it might be on a 5-year depreciation schedule. And so then depending on that, then we can actually do a lump sum bonus depreciation or accelerated depreciation in the first year of ownership. That ends up being quite significant. So we just got our first estimate on our Iowa portfolio, for example, and we purchased that portfolio for $6.4 million, and the estimated bonus depreciation is almost $5 million on that. So it's a pretty hefty, and that's year one, we can depreciate that. So when you're talking about the fact that we only actually had to bring in 30% down payment on that, our investors will get, I mean, I haven't quite done the math, but that's almost 100% of their investment back that we can give them in bonus depreciation year one.
Yeah. And then the beauty of that even as a passive investor, you got two buckets, right? Your passive investor or your real estate professional. Real estate professional, someone who like Ryan is, selling houses all day. I mean, you're in it, that's your job, whatever. The benefit of those depreciation benefits you can use to offset even active income, global active income. So investing out of your taxable pocket into these deals, you've got cash flow coming at you, but it gets all wiped, most of it or all of it, or, even more of it gets wiped out. So you're not even paying taxes on that income, and you can use it to offset other taxable income. If you're not a real estate professional, you can still use those would be passive losses to offset passive gains.
Right.
So even if you've got some other deal, maybe it's a debt fund you're investing in where there is no depreciation benefit, you can offset that cash flow that's coming in. So it's super, super powerful. Right now, with the way the tax code is laid out, we're in this 100% bonus depreciation mode right now, where, like you said, you can literally take it all up front, and then wherever you can't use, you basically just carry it. You just carry it to the next year.
Exactly.
Right? It really is a thing of beauty, right? And so obviously,
and what's cool about that, because I am that person that has the W-2 income, so I can't offset my active income, unfortunately. But I've got other properties, like I've got a rental property that I can sell and not have to worry about any of the capital gains on that, because I've got so much depreciation that will just offset that. So I don't have to do the 1031 exchange hassle, all of that, because I've got more depreciation than capital gain.
Yeah. So those are the things, to inquire about. But yeah, I think like you said, Brett, I mean, a lot of people, I think if you polled people, they would assume that the cost segregation studies or the depreciation benefits for mobile home parks is not as good, when it actually would be sort of a myth. It's as good, if not better.
Right.
In many cases. So, and those are the things, once again, as you get into these things, is just really, really, really understanding these mechanics and how they work, and then those are the questions you ask a deal sponsor, as you're going. But I mean, ultimately, that's why we do this show. It's like, you have to understand these things. It will require some education but the beauty of it is, with a lot of real estate, just like I think Brett and Ryan have hit on in this episode, right? It's just like, if you just do your homework and your research, and like, it's like anything in life. But in my opinion, the real estate stuff is tangible. It's right there to be had. It's something that can be learned. Right now, it will take years to be, to become an expert, right? And I think that's sort of the difference. But there are certain asset types like mobile home parks and things right now that are sort of going through this. It's a very unique time with that particular asset type. And, it's like many things, even if you're running private businesses, you have windows that open up where certain business types are being rolled up by these large private equity firms. And, so it's just being aware of sort of what's en vogue, because oftentimes, for a lot of you guys that are executing the strategy, a lot of you are going to be selling entire portfolios to some, Wall Street, New York, type of institutional investor for.
Hope so.
You hope so. But I mean, it's like, that's the sort of thing for numbers that seem crazy, right? Like, okay, and I think that's the exciting thing. Obviously, there's no guarantee there, but so maybe we hit on too, just some of the other things, like, with mobile home parks that you have to think of. The further north you get, you have to deal with snow removal, frozen pipes, busted pipes. I think you guys sort of teeter on that. I mean, so how do you underwrite that, that kind of stuff too, of just being mindful of, weather and impacts? Or we just see a hurricane that hit, Louisiana a few days before we recorded this. And how do you guys think about those sorts of risks that obviously are not really in your control?
Yeah, I think what our underwriting is very conservative to start with. And we bake in a good percentage for repairs and maintenance, vacancy risks as well. So Brett he's the guru on the underwriting side for us. So just helps with the stress test essentially. Now, I don't think we have a hurricane model in place at all, but for major events, we probably have a pretty conservative model that buffers that investment pretty well.
It's a blizzard thing for you guys. The Idaho properties, I'm not sure what happens in Idaho. You could get what?
Yeah.
Fire maybe.
Cold, yeah.
These days, who knows? But hopefully they're not getting any hurricanes in Missouri or Iowa. But maybe, you never know.
Yeah, and I think the other thing Ryan can talk to too, because he manages our insurance, is it's actually easier to get tornado insurance and coverage on mobile home parks than I think most people would think. Mm-hmm. It's basically a default. When we get our insurance, we can cover for tornado coverage. Mm-hmm. So yeah, in addition to having the padded underwriting, and everybody says their underwriting is conservative. I don't think anybody says we're aggressive on underwriting, but or we plan out for the best case scenario every time, right? So some of the things we do is we just make sure that our expenses are always very conservative. We try to make sure that we're increasing them based on T12, and we actually go and get real numbers by talking to contractors, utility companies, all of that, to make sure we have actual numbers that we're using. And then we buffer them up still, we pad them up. And then we also always increase the cap rate going out. So we never, I've seen a lot of people, I buy it at 6, I'm going to sell it at 4.5. And we are the opposite, where we're buying, our Iowa portfolio was blended just under a 7 cap, and we estimate 7.5 cap at exit. which I don't actually think that's going to happen. I think, like you said, the big firms are going to come in and we're going to see a lot of cap rate compression, but I don't want to count on that.
Right.
So the quotes we have or what we do are always higher cap rates.
Yeah, no, that's a good one too to pay attention to, right? It's just looking at, yeah, I mean, they bought it at whatever cap rate, but what are they projecting on the way out? And if the number's lower than what they had going in, that's cap rate compression. And that's assuming that people are going to get, super bullish and it's going to grow and, everyone wants to get in. I mean, hey, once again, it like, as I was basically saying, I think that's probably what will sort of happen. But to underwrite for it and assume it will, could be a fatal flaw. And anyone who's, like Brett, who's played with these financial models, I mean, you change the cap rate, even by, 5, 10, 15, 20 basis points, which is, 0.2%. If it's 20 basis points, I mean, it changes
dramatic.
The outcome. It's dramatic. Yeah. Like it is dramatic. And so, and it's sort of the tip off is that generally people are always quoting cap rates in, half a percentages, right? So it's 4.5, 5, 5.5, 6. And that's what's kind of funny is in a model, I mean, the difference between that one and, the 5.5 and a 6 or whatever is big. Now the shortcut, of course, is just say, well, you bought it going in at this. And if it was, higher going out and it still shows a strong IRR and a good return, then a lot of your return is coming just from operational improvements, forced appreciation, meaning your ability to go in, drive NOI is what you want to see. And the rest should take care of itself. Once again, exactly. It goes back to, it's an operational thing. This is highly operational, which is sort of a segue to my next point. When you go and buy these parks, there's communities that are already in place. These are human beings that are very close to one another. It's a different animal, even more so than multifamily, who I think is a bit more transient. I mean, that's the beauty of mobile home parks, right? It's like we just said, it costs at least $3,000, $4,000 or $5,000 to move that from there to someplace else. When you make that commitment, you're probably not going anywhere. There's friction. There's a barrier to sort of entry either way, right? Like, so,
yeah.
So what is your guys' strategy going in post-acquisition to really set the tone, right? Mm-hmm. Because I know these people, I mean, I always tell you all the time, I grew up in a mobile park, right? Like these, there is gossip and everyone knows what's going on, and the new owners in town, that's like the new sheriff. And, it's a thing that exists and can make or break, how this thing gets going. So how do you guys handle that? What's your strategy?
I think it starts with our initial communication to the residents in our letter that goes out to them. We're not planning on any major changes as far, we're not going to come in and blast rents or anything like that. In fact, we don't believe in doing that. Because that's the first thing people are they going to jack our rents up like $50 a month or whatever. And then we're looking to make improvements, like those visual improvements that people can see right away, just to show them that we want to make this community a better place to live and have that pride of ownership and have pride for people living there and want to live there. Because to your point, Lance, these are strong communities. Like the neighborhoods that Brett and I live in, most people drive into their garages, get out. They don't go outside and talk to their neighbors. But these are communities where people do that. They know each other. They watch out for each other. So you show that you're going to take good care of them and the place they live. And what we've seen is people, they start getting out and power washing their homes or painting their homes or cleaning up their yards as soon as they see us making effort to do that to like the vacant homes, things like that. Mm-hmm. So that's the type of first impression and first impact that we want to make as we start entering those communities.
There's some light things we're able to do too really quickly that make a big difference. Like Ryan's been big about doing wireless cameras, security cameras around the park, and obviously that helps residents feel safer. And then speed bumps, adding speed bumps is a pretty easy thing to just go out and do. We also do something called a paint program where we will go out and actually encourage the painting, but we'll kind of, some of that's like logistically, someone in a mobile home, they may not necessarily want to go out and find their own contractor, get the paint. Like there's just this effort to it. So we'll kind of provide the contractor, we'll kind of provide a palette of colors they can choose from. So we have a nice looking home. And then we take care of all the paint and then we just build it back to them. And that just takes all the logistics off their plate, and paint makes a huge difference in a park. So that's been helpful.
No, I love it. That's straight out of Chip and Dan Heath's book, Switch. Shape the path. You shape the path like that. You want everyone's, homes to be repainted. Just make it dead simple, right? Make it as easy as possible for them to do it, because they probably want to do it too. It's just the hassle of the friction of sort of, getting bids and, and figuring all that stuff out, and unlimited paint colors and all those things.
Exactly. It's like too much to choose from, all that. Yep.
Yeah, I love it. That's
You
great.
gotta read that book. The Stickiness Factor was good from them, but
yeah, that's right. Yeah, Switch is one of my favorite, along with Caldini's classic Influence, the 6 persuasion principles or whatever. I mean, but Switch and that one are, just classic. So last thing, I'm curious, like how you guys, what your stance is sort of on leverage. I mean, you spoke to it a bit, Ryan, with like your first park where you just couldn't get financing, seller financing. But are you going in a lot of times then having to kind of buy it all in cash and then doing a refinance down the road? Or is there financing that's more generally available? What kind of advance, like what can you get, like 50 cents on the dollar?
We haven't had to do the cash thing yet, the all cash thing. We've been pretty fortunate so far. We've been able to find some local community banks or credit unions that have like either already been familiar with the parks or familiar with the communities, and they're investing in them. I was a little shocked actually, just using our Missouri portfolio as an example. So we're buying 4 parks there over the course of about 6 weeks, because it's 4 parks but 3 different sellers. So it's not all one acquisition, but we did it as kind of a mini fund where it's the same group of investors, like one syndication, if that makes sense. Mm-hmm. And each one of these parks, one of them is probably class B plus, class A minus, like really nice park. But the other 3 are very distressed. They're more like turnaround projects. One of them isn't even cash flowing. So these are just like, we're really excited about the cost we're getting out is super low. We see that like we can double to triple the values within just a year or 2 with some easy sweat equity. Well, easy, right?
Well, yeah.
Work we've done.
You run your plays. Yeah.
But it's not your like Fannie Freddie debt that you're getting where they're like, oh, you're 85% occupied and this is amazing, so let's give you all this debt. All that being said, this bank gave us 80% loan to cost and a 4.2% interest rate. So it's as close to agency as you can get without being agency grade mobile home park. So that's where we've just found the success, is just finding the local banks that believe in the vision and are willing to invest in it to get the leverage you need. Otherwise, I think to your earlier point, yeah, you're looking at like 50, 60% leverage on more of the national lenders, which just hurts a deal. You got to have the cheaper financing to make it work.
Yeah. And I think before we hit record, I mean, you were, lamenting a bit. It's just, it does, when you go with the regional banks, local banks, it's a little bit more work. You got to kind of wade through stuff. It takes time, but I mean, those are great terms, right? And so a lot of times, if you can get to that point, it's well worth it. That's great. I mean, I love having this conversation. We could go on, all day. Why don't you tell people, if they're interested in learning more and getting involved with some of these investments you guys are doing, where can they find out about, Suncrest and reach out and get a hold of you guys? Yeah.
So we have our VeriVest profile up. So that's one way, but our website's just suncrestcap.com. So CAP, cap, short for capital. Both of us have our emails on there, contact information, but it's just Brett at Suncrest Cap and Ryan at Suncrest Cap. And then we're both active on LinkedIn too. So those are all great ways to find us.
That's awesome. Well, thanks so much, fellas. You have a great weekend. Thank you for joining me. Enjoyed our time. And we will be in touch.
Absolutely. Thanks a lot, Lance.